Folks, we're getting so many landlords coming to us right now. And either they have not filed taxes in several years, or they have filed taxes, but it has suddenly dawned on them that maybe they haven't taken depreciation, or they think that they've taken depreciation wrong, and it's just a big, huge mess now that has to be untangled. So to prevent you, if you're a landlord out there with rental properties, to prevent you from falling into this situation and having to call us on the phone and say, hey, I screwed up my rental property depreciation. Can you help me out with this? I know we don't do it for free. We will charge you to help you out with that because it can be a very time intensive process to fix. Sometimes just a matter of amending a couple returns. Other times we have to do a whole form 3115, right? But to kind of get out ahead of this for some of you landlords out there, I want to go over the 5 biggest mistakes that landlords tend to make when depreciating their rental property. And this is a topic near and dear to my heart, both as a real estate investor, a rental property owner myself, and as a CPA, because years ago I was actually in the real estate group at a big 4 accounting firm. One of my biggest clients was a real estate firm called Kennedy Wilson. They were a publicly traded company on the New York Stock Exchange. If you kind of Google some of their old tax filings, you can kind of see my name there at the bottom of them when I was working for Ernst & Young. Anyway, not to bore you with my career history, but just to kind of show you, hey, I kind of know what I'm talking about when it comes to real estate. So without further ado, here are the 5 biggest mistakes that I see landlords make when depreciating their rental property. Mistake number 1, they don't take depreciation at all. That's right. We've reviewed tax returns from landlords who come to us. They're like, hey, can you do my tax returns? And we're like, sure, we'll do your tax returns. And we look at their old tax returns and look at all their rental properties on their Schedule E. Sometimes they have dozens of them. No depreciation expense. And it wasn't because they had depreciated the entire building because they had purchased the property, decades ago, right? It was because they simply never took depreciation expense. And in many cases, that has cost them some money over the years because they were paying too much in taxes. How do we fix that? Well, we usually fix that by filing what's called a form 3115, application for change in accounting method, because by this point, they have already established an accounting method of not taking depreciation expense. And so we have to fix that. We have to recalculate what their depreciation would have been every year. We have to get the original closing statements on, their properties, look at any additional capital improvements they've made over the year. It can be a big, hairy, expensive mess. So if you're out there, you bought a rental property this year and it's placed in service, it's rent ready, please take depreciation and do it correctly, which hopefully by the end of this video, you'll know how to do. Because folks, if you don't take depreciation, believe it or not, you're still on the hook for depreciation recapture. That's right. You got to pay depreciation recapture on either the amount of depreciation you actually took or the amount that you could have taken. Okay? Is depreciation allowed? That means actually taken on a return, or allowable, which means you could have taken on a return but you didn't. Right? So it's in your best interest to calculate depreciation on your rental properties, or you could be stuck with not only a bigger tax bill than you should have over the years as you're operating that rental property, but also a bigger tax year than you should when you go and sell that rental property. Second mistake we see is landlords not using their actual basis in their property as the basis for their depreciation. Let me explain. When you buy an asset, like a rental property, before you take depreciation on that asset, you got to know what your basis is in the property. Your basis is what you paid for the property, okay? And some folks, what some landlords do is they just look at the, they don't remember, they don't have their settlement statement or closing statement, so they just look at the county assessor's office and see, well, what was their valuation of my property, right? And oftentimes that'll get you close, kind of, right? Sometimes not at all. But that's not actually what you should base your tax depreciation on your tax return on. What you should be doing is you should be getting your closing statement from the transaction, right? Starting with that purchase price figure, and you're going to adjust it. You're going to adjust it for various things that might be found on the closing statement. Like when you're the buyer, you're not typically paying all these things. Oftentimes, the seller will cover your closing costs. But there's a lot of things that you might be paying as a buyer that you should still be including in your basis in the rental property, right? Title insurance, right? Any cost that you had to incur recording costs, any costs that you had to incur in order to purchase this property. Now, costs you incurred to get a loan on that property, to take out a mortgage, that's something else. Those loan fees you should amortize over the length of your loan. So sometimes on your closing statement, there's stuff in your closing statement that has to be added to your basis, right? And depreciated, at least the portion that's allocated to building. And there's some stuff on your closing statement that you may allocate towards loan costs and amortize straight line over the length of your mortgage, right? So if it's a 30-year mortgage over 30 years. And there might be other costs that don't appear in your closing statement that you should include in one of those things. For example, if you paid for an appraisal, right, on the property as a condition of your loan, and you paid for that appraisal outside of escrow, that may or may not appear in your closing statement, right? But you should include that as a loan cost that you amortize over the length of your loan, of your mortgage, because that was a cost that you incurred in obtaining a loan, right? Similarly, for a homeowner's inspection, right, you would include that in the basis of your rental property that you allocate between building and land, and then depreciate the building portion respectively. On that note, third mistake that we see landlords make when it comes to depreciation of rental property is they depreciate the land as well as the building. Okay, so let's say you buy a rental property, let's say for $500,000, right? You have to split, and you're going to make adjustments, right, for the basis. Okay, that I just talked about over the past few minutes. So let's say by the time you make all those adjustments, your basis in the property is actually $510,000 or something like that. Well, you got to take that figure and you got to split it between land and building, okay? Because it's only that building portion that you're allowed to take a depreciation deduction on. The most common way that landlords as well as tax accountants do this isn't the only way, okay? But it's oftentimes the simplest way, is by simply looking at the property tax bill, the county assessor, and on the property tax bill, the county assessor is going to make a split between land and building. Okay, you're not going to just take that building number and use that as your depreciable basis. I already covered that. No, you're going to take the percentage of the total, right, valuation for the property that the assessor has ascribed to improvements, which is basically the word for building. Multiply that by your total basis in the property, and that's your depreciable basis, at least initially, your depreciable basis in the building. So example, let's say you bought that rental property $510,000. You go to the county assessor's website. You can look most counties you can look up online now. You look at how the assessor makes this, and let's say the assessor says, well, the value of the land, let's just say it's 50-50. The value of the land was $250,000 or $200,000. The value of the improvements was $200,000, right? So 50-50. So what you do is you take that $510,000 basis you calculated, looking at the closing statements, taking into cost other costs, times that by that 50% percentage that's attributable to improvements based on the assessor's records, right? Or it could be some other split. It could be 60-40. It could be 90-10. If you're in some, very high cost of living area where the land is, the value is mostly in the land, right? And then when you have that building basis, that is the amount that you can take a depreciation deduction on, okay? Now, you still have that basis in the land, right? That still helps you out when you go and sell the property, right? But you can't depreciate the land. So what do you do with that building basis? Well, with that building basis, you have to depreciate it over a certain number of years, okay? And this is the fourth mistake that we see landlords making when it comes to calculating depreciation. Now, most rental property is going to be categorized as either residential rental property or non-residential rental property, right? Residential rental property generally means people live in it. Non-residential rental property means people don't live in it, right? So that's like, you own an office building or something. Residential rental property is generally depreciated over 27 and a half years, while non-residential rental property is generally depreciated over 39 years. Now that's for U.S. property. If your property is overseas and is residential rental property, depreciate over 30 years. And if it's non-U.S. Non-residential rental real estate, you depreciate that over 40 years, right? And people get these confused. They get it mixed up, right? And sometimes they just don't use the right number, right? We've seen people trying to depreciate the rental property over like 5 years or something, and that's not gonna work. That's just begging the IRS, audit me, please. All right, fifth and last point. This is kind of related to this. Is if you know anything about taxes and depreciation, you're gonna laugh at this. Number 5 mistake, biggest mistake that we've seen landlords make when it comes to tax depreciation is taking bonus depreciation on the entire rental property. Yes. Now, rental property is not eligible for bonus depreciation. Now, caveat: if you get a cost segregation study done, and they segregate your basis, you're building the basis that you would initially just depreciate over 27 and a half years or 39 years if you didn't get a cost seg done. You could get a cost seg done, and you get a nice little cost seg report that tells you, well, okay, here's your total basis, but here's the breakdown to 5-year property, 7-year property, 15-year property, etc. Right? You can take bonus on some of that stuff, right? Not the 27 and a half year and 39 year, right? But if you segged out some of your basis into bonus eligible components, then you could take bonus on that, right? We can't take bonus on the whole thing, right? So we've seen landlords take bonus depreciation, or try to take bonus depreciation on the whole thing, because for a while we had 100% bonus depreciation, right? In 2023, 80%, 2024 now 60%, right, etc. But like let's say in 2020 or something, let's say 2018 or something, so someone took bonus depreciation. They would just basically write off the entire cost of their rental property. And if they didn't separate between land and building, they would do their whole cost, right? So don't make that mistake. That's basically asking the IRS to audit you, right? Because you imagine you buy a property for $1 million and then there's $1 million depreciation deduction right there. Forget about land and building. Forget about appropriate useful lives. We're just deducting the whole thing in this year. All right, folks, so those are my 5 biggest mistakes that I see landlords make when it comes to rental property depreciation. Hey, if you're a landlord out there and you think you might have made some mistakes with your rental property depreciation, hey, give us a call. Choice Tax Relief, 866-8000-TAX. That's 866-8000-829. Or you can visit us at choicetaxrelief.com. Fill out the form on the website. We'll be happy to reach out to you then. I also have some other tax videos here on the left-hand side of your screen. That's about it. Thanks so much for watching, everybody. See you in the next video. Bye-bye.